Powerful financial inducements are driving the growth of sustainability, but are positive economic incentives able to tackle the complexities of the Polycrisis? A comprehensive body of scientific evidence clearly indicates that we are headed towards cascading calamity and intensifying civilization-ending threats. According to a risk report from the World Economic Forum, WEF, the health of our biosphere is deteriorating at an alarming rate, and we are inching ever closer to irreversible tipping points. A 2024 WEF poll indicates that 80% of world leaders expect the polycrisis to worsen, saying they anticipate consistent ongoing crises that are compounding each other on an increasingly volatile trajectory. And the green economy. As explained by Cristiana Figueres, the former executive secretary of the UNFCCC, market incentives are reshaping the landscape of global commerce, proving that what's good for the environment can be good for the bottom line. Both the private and the public sectors are driving the growth of the green economy. Corporations see sustainability as more than just a megatrend. It is a strategic imperative that confers economic benefits and long-term competitive advantages. Governments are providing financial inducements like tax breaks and investment tax credits in support of technologies like renewable energy, carbon capture, and carbon removal. The data points to prodigious growth. A report from Research and Markets indicates the global market for the green technology and sustainability is projected to grow from $28.6 billion in 2024 to $134.9 billion by 2030. With a compound annual growth rate of 29.5%. By 2050, Oxford Economics projects the green goods and services market will be a $10.3 trillion opportunity, which is equivalent to 5.2% of global GDP. Sustainability and green economy represent unprecedented investment opportunities. There has been a big uptick in impact investing over the last decade, and investors have flocked to companies, organizations, and funds that generate a measurable beneficial social or environmental impact. According to the Global Impact Investing Network, between 2013 and 2021, the impact investing market grew at a 45% CAGR, with almost 90% of investors claiming they had met or exceeded their financial expectations. Socially responsible investing, SRI, is the practice of investing in companies and funds that have positive social impacts. There has been a burgeoning interest in SRI over the last 20 years. As Elsevier publication indicates, in 2012, SRIs accounted for more than 20% of global capital markets, with assets based on SRI principles exceeding $30 trillion. Environmental social governance, ESG, is an investment framework that focuses on the triple bottom line: profit, people, and the planet. Investors interested in ESG analyze a company's impact and alignment with societal values. According to a Grandview Research Market Analysis report, the global ESG investing market size was estimated at $25.10 trillion in 2023 and is projected to grow at a CAGR of 18.8% from 2024 to 2030. JP Morgan estimates that there is as much as $45 trillion in ESG-related assets under management. Replacing fossil fuels with renewable energy is crucial for a wide array of environmental, social, and economic reasons. The trend is clear. Renewables are destined to bury fossil fuels. The transition is feasible and well underway. Europe is already getting more electricity from clean sources than fossil fuels. As explained by Mark Jones, a political science fellow at Rice University in Houston, there's a clear understanding that, in fact, renewables are the future. The move towards renewable energy is being driven by economics. A Tesla report indicates that the transition will save $4 trillion, while an Oxford University study suggests a rapid transition could save $12 trillion. The rapidly declining costs of renewables and energy storage embolden a strong business case. Falling wind and solar prices are propelling renewables into a position of dominance, and the cost will keep declining as they scale. Governments are supporting the clean energy transition and contributing to the prodigious growth of renewables that has consistently outpaced expectations. Year after year, new renewable energy capacity is setting records. Renewables are the fastest growing source of electricity, currently generating almost a third of global electricity production, and they are on the cusp of being the largest source of electricity in the world. According to SkyQuest, the global renewable energy market was valued at $899 billion in 2022 and is poised to grow to over $1 trillion in 2023 and $3.6 trillion by 2031. The IEA forecasts the transition to renewable energy represents a $4 trillion opportunity. Technologies that capture or remove carbon are another multi-trillion-dollar opportunity. The number of plants that capture carbon at source, carbon capture, and from the ambient air, carbon dioxide removal or CDR, is growing at ever-increasing rates. According to a report by Spherical Insights and Consulting, the global carbon capture market was valued at $2.98 billion in 2023 and is expected to reach $25 billion by 2033. By mid-century, carbon capture is projected to be a $4 trillion opportunity, while CDR is projected to be a $1.2 trillion opportunity. Investors are funneling trillions of dollars towards sustainability-focused enterprises and green technologies like renewable energy, which has benefited tremendously from government incentives. While generous inducements and lucrative opportunities have made a difference, they have not produced results at the scale we need to see. We are not seeing anywhere near enough action to stave off disaster. As David King, the founder and chair of the Climate Crisis Advisory Group, explained, despite mounting evidence and urgent pleas, meaningful action falters. While renewable energy capacity keeps increasing, we are still not transitioning away from fossil fuels. Over the last decade, global energy demand has consistently grown faster than renewable energy has increased. While economic incentives are supporting the growth of renewables, market economics still favor fossil fuels. The failure of economic incentives is also evident in ongoing record-breaking heat, extreme weather, biodiversity loss, and species extinctions. Greasing the markets have not stopped forests from burning, deserts from expanding, and clean water from becoming ever more scarce. Government support has not been able to protect our oceans from the triple threats of acidification, warming, and anoxia that is killing coral reefs and collapsing fisheries. Market mechanisms have not stopped the ice from melting or sea levels from rising, nor have they prevented us from surpassing planetary boundaries. Incentives have not contained a wave of social impacts associated with these biophysical threats. We are seeing increasing inequality, injustice, tension, conflict, and war. The worsening Polycrisis is also inciting political divisions and contributing to the rise of authoritarianism. Financial inducements have proven to be incapable of addressing the complexities of the Polycrisis. The market system has failed to deal with the long-standing social and environmental threats we face. The scale and complexity of the Polycrisis now dwarfs the capacity of market incentives to produce the kind of changes we need. The fact that we are not moving away from fossil fuels illustrates the failure of economic incentives. Growing greenhouse gas emissions, largely attributable to fossil fuel use, are warming the planet and driving climate change, which is at the core of the Polycrisis. In 2024, atmospheric levels of CO2 exceeded 427 parts per million. To put this in context, the pre-industrial level of atmospheric CO2 was 280 parts per million, while the safe upper limit is considered to be 350 parts per million. According to a paper published in the Proceedings of National Academy of Science, atmospheric CO2 is rising 10 times faster than at any time in recorded history. A Guardian survey reveals that a clear consensus of climate scientists think that unless we change our trajectory, we will easily push past the upper threshold temperature limits of 1.5 to 2 degrees C above pre-industrial norms. The 2023 emissions gap report concludes that increasing emissions means there is a 90% chance that by 2100 we will see warming between 2.3 degrees C and 4.5 C above acceptable upper threshold limits. The Copernicus Climate Change Service estimates that 92% of current warming is attributable to human-generated GHGs, and a study published in Nature indicates that warming is accelerating much more quickly than anticipated by climate models. Global average temperatures have already breached 1.5 C above pre-industrial norms, and high temperature records are being broken with regularity as each year trends ever warmer. The inadequacy of our response to the climate crisis exposes the yawning gulf between what we must do and what we are doing. Government support and massive investor interest have not been able to adequately address what the UN Secretary General called the defining issue of our age and the central challenge of our century. We are already seeing clear signs of a climate breakdown, and if our inaction continues, a slew of studies warn it will get dramatically worse. MIT academic and author Noam Chomsky called climate change the defining issue of human history, adding, "We're reaching a point where irreversible processes will be set into motion, where it's just decline to disaster." While government incentives and responsible investments are beneficial, they have failed to muster a response anywhere near the required scale. We are barreling headlong towards disaster at ever-increasing speed, and the menacing array of interrelated biophysical, social, and economic threats are coalescing and hybridizing.